Imagine waking up one morning to news headlines screaming about a stock market plunge. Your phone buzzes with alerts of plummeting retirement savings. Your carefully planned future feels shaky. At work, whispers of layoffs circulate, casting a shadow of anxiety over your colleagues. This is not mere dystopian fiction. It's a plausible scenario if a significant economic crash were to hit in 2024. A crash, in essence, is a sudden and dramatic downturn in economic activity, often accompanied by a stock market collapse, rising unemployment, and a drop in consumer spending. The ripple effect of a crash can be devastating. Businesses struggle to stay afloat, leading to job losses. Families grapple with reduced income and mounting debt, forcing them to cut back on essential expenses. The overall sense of financial security evaporates, replaced by uncertainty and fear. While we haven't experienced a full-blown financial crisis since 2008, the global economy is flashing warning signs, making it crucial to understand the factors at play and how we can mitigate the risks. One of the most prominent red flags is persistent inflation. Inflation, simply put, is the rate at which prices for goods and services rise over time. When inflation is high, our money buys less, eroding purchasing power. Central banks, like the Federal Reserve in the US, typically respond to high inflation by raising interest rates. Higher interest rates make borrowing more expensive, which can slow down economic activity. This cooling effect is intended to curb inflation, but also carries the risk of pushing the economy into a recession. The current economic climate is particularly challenging because we're facing both high inflation and rising interest rates. This delicate balancing act makes it difficult to tame inflation without triggering a sharp economic downturn. Another major concern is the high level of debt across all sectors of the economy. Consumers are grappling with record levels of credit card debt and student loans. Corporations have taken advantage of low interest rates in recent years to load up on debt, making them vulnerable if economic conditions worsen. Governments, too, are burdened with massive debt loads. The US national debt, for example, has soared to unprecedented levels, raising concerns about the country's long-term fiscal sustainability. High debt levels can exacerbate an economic downturn as borrowers struggle to repay their obligations, potentially triggering a cascade of defaults. This interconnected web of debt creates a fragile economic ecosystem where a shock in one area can rapidly spread throughout the system. The housing market, a key driver of economic growth, is also showing signs of instability. The years of ultra-low interest rates fueled a housing boom, with prices skyrocketing in many regions. However, as interest rates rise, affordability becomes a major issue, potentially leading to a slowdown in the housing market. A housing market correction where prices decline significantly could have ripple effects throughout the economy. Homeowners could face a decline in their net worth, leading to reduced consumer spending. Construction activity could slow down, impacting jobs and economic growth. The housing market's sensitivity to interest rates makes it a potential trigger point for a broader economic downturn. The global landscape, interconnected economies, shared risks. It's crucial to remember that economic risks don't respect national borders. We live in a highly interconnected global economy, where events in one country can quickly reverberate across the world. The ongoing war in Ukraine, for example, has disrupted supply chains, fueled inflation, and created economic uncertainty on a global scale. China's economic slowdown, another key concern, could have significant implications for the rest of the world. As the world's second-largest economy, China's growth has been a major engine of global economic expansion. A slowdown in China could dampen demand for goods and services worldwide, putting a drag on global growth. This interconnectedness means that economic risks are shared, making it essential for countries to cooperate and coordinate policies to mitigate potential crises. The tech tremor. Overvaluation and the innovation slowdown. The tech sector, once a symbol of boundless growth and innovation, is also facing headwinds. Valuations of many tech companies have soared in recent years. fueled by low interest rates and investor enthusiasm. However, this rapid growth has raised concerns about overvaluation, making the sector vulnerable to a correction. Moreover, the pace of technological innovation, while still remarkable, may be slowing down. The groundbreaking advancements that characterized the early years of the internet and mobile technology seem to be less frequent. This slowdown in innovation could impact future economic growth, as technological progress has been a key driver of productivity gains. The tech sector's outsized influence on the global economy makes its current challenges a significant risk factor to consider. Can we avert the crash? Fiscal and monetary policy. The good news is that governments and central banks have tools at their disposal to try to prevent or mitigate an economic crash. Fiscal policy, which involves government spending and taxation, can be used to stimulate economic activity. For example, governments can invest in infrastructure projects, provide tax breaks to businesses, or increase social welfare spending to boost demand. Monetary policy, controlled by central banks, primarily involves adjusting interest rates. As mentioned earlier, raising interest rates can help curb inflation, but also risks slowing down the economy. Lowering interest rates can stimulate borrowing and spending, but may exacerbate inflation. Finding the right balance between these policies is a delicate act, requiring careful analysis of economic data and a nuanced understanding of the complex interplay of factors at play. Preparing for the storm. Personal finance in uncertain times. While we hope for the best, it's also prudent to prepare for the possibility of an economic downturn. Here are some steps you can take to strengthen your personal finances. Build an emergency fund. Aim to have 3 to 6 months' worth of living expenses saved in a readily accessible account. This will provide a financial cushion in case of job loss or unexpected expenses. Reduce debt. Focus on paying down high-interest debt, such as credit card balances, to reduce your financial burden. Diversify investments. Don't put all your eggs in one basket. Spread your investments across different asset classes, such as gold and real estate, to reduce your risk. Live within your means. Track your spending carefully and make adjustments to ensure you're not spending more than you earn. By taking these proactive steps, you can increase your financial resilience and weather economic storms more effectively. A brighter future. Opportunities amidst the challenges. While the economic outlook may seem daunting, it's important to remember that challenges often bring opportunities. Economic downturns can spur innovation, forcing businesses to become more efficient and adapt to changing circumstances. These periods can also present opportunities for investors who are willing to take calculated risks. Market downturns often create buying opportunities as asset prices become more attractive. The key is to stay informed, make sound financial decisions, and maintain a long-term perspective. While economic cycles are inevitable, history has shown that economies tend to recover and grow over time. Want to stay ahead of the curve on the latest economic trends and insights? Subscribe to our channel Express Econ Geofinance Insights for expert analysis, actionable advice, and a clear-eyed view of the economic landscape.